Welcome. Today, we're diving into the new senior deduction introduced by the One Big Beautiful Bill Act, or OBBBA. This recent legislation brought significant changes to the U.S. tax code, especially for older Americans. The senior deduction is a temporary measure designed to provide tax relief for seniors, but it also adds new layers of complexity to the tax system. In this video, we'll break down what the deduction is, who qualifies, how much it's worth, and what it means for the federal budget and individual taxpayers. Let's start by understanding the background and motivation behind this new policy. The One Big Beautiful Bill Act, often referred to as OBBBA, was passed following the 2024 presidential campaign. During the campaign, there was a strong push for no taxes on Social Security. Instead, lawmakers opted for a broader approach, creating a new tax deduction specifically for seniors. This move was intended to provide targeted relief while addressing concerns about the complexity and fairness of the tax code. The OBBBA's senior deduction is just one part of a much larger package of tax reforms, but it has quickly become a focal point in discussions about fiscal policy and the federal budget. So, what exactly is the new senior deduction? Under the OBBBA, seniors can now deduct up to $6,000 from their taxable income if filing individually, or $12,000 if married and filing jointly. To qualify, you must be at least 65 years old and provide your Social Security number on your tax return. However, there's an income limit. The deduction begins to phase out for individuals earning over $75,000 or $150,000 for joint filers. This deduction is in addition to the standard deduction and other existing tax breaks for seniors, making it a valuable, though somewhat complex, benefit for those who qualify. To claim the new senior deduction, there are a few key eligibility requirements. First, you need to be at least 65 years old by the end of the tax year. Second, you must provide your Social Security number on your tax return. Third, your income must not exceed $75,000 if filing individually, or $150,000 if filing jointly, as the deduction phases out above these thresholds. These requirements are designed to target the deduction toward middle-income seniors, but they also add a layer of complexity to the filing process, especially for those close to the income limits. Let's look at how the deduction works in practice. If you're eligible, you can claim the senior deduction in addition to the standard deduction, which was also increased under the OBBBA. For 2025, the standard deduction is $15,750 for those who don't itemize. Seniors also qualify for an additional standard deduction of $2,000 or $1,600 per person for married couples. The new senior deduction stacks on top of these, potentially reducing taxable income by thousands of dollars. However, the phase-out means that higher-income seniors may see a reduced or eliminated benefit. Stacking deductions can be confusing, so let's clarify. If you're a senior, you may be eligible for 3 separate deductions: the standard deduction, the additional senior deduction, and the new senior deduction from OBBBA. For example, in 2025, a single senior could potentially deduct $15,750, standard, $2,000, additional, and $6,000. New senior deduction, totaling $23,750. For married couples, these amounts are even higher. However, the phase-out rules mean not everyone will get the full benefit, especially those with higher incomes. The phase-out mechanism is a key feature of the new senior deduction. Once your income exceeds $75,000 as an individual, or $150,000 as a couple, the deduction begins to decrease. This means that higher-income seniors will see their deduction reduced or eliminated entirely. The phase-out is designed to target the benefit toward middle-income seniors, but it also means that the deduction is less valuable for those at the top of the income scale. Understanding where you fall on this spectrum is crucial for effective tax planning. It's important to note that the new senior deduction is temporary. The provision is set to expire in 2028, just 4 years after its introduction. This creates uncertainty for retirees and those planning for the future, as it's unclear whether Congress will choose to extend the deduction or let it lapse. If extended, the cost to the federal government could double, making it a significant factor in future budget debates. For now, seniors should be aware that this benefit may not be permanent. According to the Joint Committee on Taxation, the new senior deduction is expected to reduce federal revenues by $91 billion over the next 4 years. If Congress extends the deduction beyond 2028, the total cost could reach $220 billion by 2034. This significant reduction in revenue will add to the federal deficit, which is already a major concern for policymakers. The cost of the deduction is a central issue in debates about its future and the overall sustainability of the federal budget. The new senior deduction doesn't just affect individual taxpayers, it also has a broader impact on the national debt. The OBBBA as a whole is projected to increase the deficit by $4.1 trillion over 10 years, including interest costs. The senior deduction alone accounts for a substantial portion of this increase. As the national debt continues to rise, policymakers are under pressure to find ways to balance tax relief with fiscal responsibility. The debate over the senior deduction is part of a larger conversation about the future of U.S. fiscal policy. Not all seniors will benefit equally from the new deduction. According to the Tax Policy Center, fewer than half of older adults will actually see a benefit. The lowest income seniors typically have taxable income below the standard deduction, so they gain nothing from the new provision. The highest income seniors are phased out of eligibility. The primary beneficiaries are middle and upper middle income seniors, who receive the bulk of the tax cuts. This targeted approach has both supporters and critics. Middle-income seniors are projected to receive the most significant average benefit from the new deduction. In 2026, the average tax cut for this group is estimated at $220, which represents about 0.3% of their income. While this may not seem like a huge amount, it can make a meaningful difference for those on fixed incomes. The deduction is designed to provide targeted relief to this group, helping to offset the rising cost of living and other financial pressures faced by retirees. Upper middle income seniors are projected to receive the largest average benefit from the new deduction. In 2026, this group is expected to get an average tax cut of $300, or about 0.2% of their income. While the percentage is lower than for middle income seniors, the dollar amount is higher. This reflects the structure of the phase-out and the way the deduction is calculated. For upper middle income retirees, the deduction can provide a modest but welcome boost to their finances. Unfortunately, the lowest income seniors receive no benefit from the new deduction. That's because their taxable income is already below the standard deduction and existing senior deduction, so they have no additional tax liability to reduce. This highlights a limitation of the policy. While it's designed to help seniors, it doesn't reach those who may need the most support. Instead, the deduction primarily benefits those with moderate to higher incomes, leaving out the most vulnerable retirees. The introduction of the new senior deduction adds another layer of complexity to the U.S. tax code. Seniors now have to navigate multiple deductions, income phase-outs, and eligibility requirements. For many, this means more paperwork and a greater need for professional tax advice. The added complexity can be especially challenging for those who are not familiar with tax rules or who have limited access to financial resources. Simplifying the tax code remains a major goal for many policymakers. Because the new senior deduction is temporary and set to expire in 2028, retirees face uncertainty about future tax planning. Will Congress extend the deduction, or will it disappear after 4 years? This lack of clarity makes it difficult for seniors to make long-term financial decisions. Many retirees rely on predictable tax rules to plan their budgets, so any changes or uncertainty can cause stress and confusion. Policymakers are under pressure to provide more stability in the tax code. Before the OBBBA, seniors could already claim an additional standard deduction. The new senior deduction stacks on top of this, but it's important to compare the two. The existing additional deduction is $2,000 for singles and $1,600 per person for married couples in 2025. The new deduction is larger, but comes with stricter eligibility and a phase-out. Understanding the differences helps seniors make informed decisions about which deductions they can claim and how to maximize their tax savings. The rationale behind the new senior deduction is to provide targeted tax relief to older Americans, especially those in the middle-income brackets. Lawmakers wanted to address concerns about the tax burden on retirees while also responding to political pressure for no taxes on Social Security. By creating a new deduction, they aimed to strike a balance between relief and fiscal responsibility. However, the policy has sparked debate about its effectiveness and fairness. Critics argue that the new senior deduction adds unnecessary complexity to the tax code and fails to help the lowest income seniors. They point out that the benefit is skewed toward those who are already relatively well off, while the most vulnerable retirees are left out. Additionally, the deduction's temporary nature and high cost to the federal budget have raised concerns about its long-term sustainability. These criticisms are central to ongoing policy discussions. Supporters of the new senior deduction argue that it provides much-needed relief for retirees facing rising costs. They believe the deduction helps middle-income seniors keep more of their income, making retirement more secure. Proponents also argue that the deduction is a fair way to address the unique financial challenges faced by older Americans, especially as healthcare and living expenses continue to climb. For many, the deduction is a step toward a more supportive tax system for seniors. The new deduction has significant implications for tax planning among seniors. With multiple deductions and phase-outs to consider, retirees may need to adjust their strategies to maximize their tax savings. Some may benefit from consulting a tax professional to ensure they're taking full advantage of available deductions. The temporary nature of the deduction also means that seniors should stay informed about potential changes in tax law that could affect their future finances. Reducing federal revenues by $91 billion over 4 years, the new senior deduction is a major factor in the government's fiscal outlook. Lower revenues mean higher deficits, which can impact funding for other programs and services. Policymakers must weigh the benefits of tax relief for seniors against the broader need for fiscal sustainability. The debate over the deduction is part of a larger conversation about how to balance competing priorities in the federal budget. As the 2028 expiration date approaches, there is growing debate over whether Congress should extend the senior deduction. Supporters argue that extending the deduction would provide continued relief for seniors, while opponents worry about the cost and complexity. If extended, the total cost could reach $220 billion by 2034. The outcome of this debate will have major implications for retirees and the federal budget alike. In addition to the new senior deduction, there are several other tax breaks available to older Americans. These include the standard deduction, the additional senior deduction, and various credits and exclusions. Understanding how these benefits interact is key to maximizing tax savings. Seniors should review all available options and consider how changes in the law may affect their eligibility and overall tax liability. Refundable tax credits are another important tool for reducing tax liability, especially for lower-income individuals and families. While the new senior deduction is not refundable, understanding the difference is important. Refundable credits can result in a tax refund even if you owe no tax, while deductions only reduce taxable income. The cost and impact of refundable credits have grown in recent years, making them a key part of the broader tax policy landscape. Estate and gift taxes are another area of the tax code that affects seniors, especially those with significant assets. These taxes generate less revenue than other sources, but often attract attention and controversy. Understanding how estate and gift taxes work can help seniors plan for the transfer of wealth and minimize potential tax liabilities. It's important to stay informed about changes in these laws, as they can have a big impact on retirement and legacy planning. Tax breaks for individuals totaled over $2 trillion in 2025, more than the government spends on Social Security, defense, or Medicare and Medicaid. The new senior deduction is just one of many provisions that reduce tax liability for individuals. Understanding the largest tax breaks can help put the senior deduction in context and highlight the importance of tax policy in shaping government revenues and spending priorities. The Peter G. Peterson Foundation plays a key role in educating the public about fiscal policy, including tax reforms like the new senior deduction. The foundation provides resources, analysis, and advocacy to promote long-term, nonpartisan solutions for a healthy and growing economy. By engaging with policymakers, experts, and the public, the foundation helps shape the conversation around fiscal responsibility and sustainable tax policy. Beyond tax policy, the Peterson Foundation supports a range of programs and projects aimed at advancing fiscal solutions, engaging young Americans, strengthening democracy, and convening experts. These initiatives are designed to foster informed debate and encourage responsible decision-making at all levels of government. The Foundation's work extends to healthcare, technology, and philanthropy, reflecting a broad commitment to public service. Fiscal responsibility is at the heart of the debate over the new senior deduction and other tax policies. As the national debt grows, policymakers must find ways to balance tax relief with the need for sustainable government finances. This means making tough choices about spending, revenue, and the structure of the tax code. The goal is to create a system that is fair, efficient, and supportive of economic growth, while also ensuring long-term fiscal health. For seniors and all taxpayers, navigating changes in the tax code can be challenging. Staying informed about new deductions, credits, and rules is essential for making the most of available benefits. Resources like the Peterson Foundation and professional tax advisors can help individuals understand their options and plan for the future. As tax laws continue to evolve, ongoing education and engagement are more important than ever. There are many resources available to help seniors understand and navigate the new deduction and other tax benefits. Government websites, nonprofit organizations, and professional advisors all offer guidance and support. Taking advantage of these resources can help seniors maximize their tax savings and avoid costly mistakes. It's always a good idea to review your tax situation annually and seek help if you have questions or concerns. To claim the new senior deduction, eligible seniors must provide their Social Security number on their tax return and ensure they meet the age and income requirements. The deduction can be claimed in addition to the standard and additional senior deductions. It's important to keep accurate records and consult the latest IRS guidance to make sure you're claiming the correct amount. If you're unsure, consider working with a tax professional. The introduction of the new senior deduction has sparked calls for broader tax reform. Many experts believe the tax code should be simpler, fairer, and more supportive of economic growth. Future reforms may focus on consolidating deductions, expanding credits for low-income seniors, or restructuring the phase-out rules. The ongoing debate highlights the need for a tax system that works for everyone, not just a select group. Public engagement and advocacy play a crucial role in shaping tax policy. Organizations like the Peterson Foundation encourage citizens to get involved, stay informed, and share their perspectives with policymakers. By participating in the policy process, individuals can help ensure that tax laws reflect the needs and values of the broader community. Active engagement is key to creating a more responsive and effective tax system. Tax policy is always evolving, and staying updated is essential for making informed decisions. Subscribing to newsletters, following reputable organizations, and regularly checking government websites can help you keep track of changes. The Peterson Foundation, for example, offers timely updates and analysis on fiscal and economic policy. Staying informed empowers you to adapt to new rules and make the best choices for your financial future. To recap, the new senior deduction introduced by the OBBBA offers targeted tax relief for seniors, but comes with important limitations and complexities. It's temporary, phases out at higher incomes, and doesn't benefit the lowest income retirees. The deduction adds to the federal deficit and raises questions about long-term fiscal sustainability. Understanding the rules and staying informed is crucial for making the most of this and other tax benefits. Looking ahead, the future of the senior deduction and broader tax policy remains uncertain. Policymakers will need to weigh the benefits of targeted relief against the need for fiscal responsibility and simplicity. Ongoing public engagement and expert analysis will be essential in shaping the next generation of tax reforms. For seniors and all taxpayers, staying informed and proactive is the best way to navigate the evolving landscape. If you're interested in shaping tax policy and advocating for responsible reforms, there are many ways to get involved. Organizations like the Peterson Foundation offer opportunities to participate in discussions, share your views, and stay updated on the latest developments. By joining the conversation, you can help ensure that tax laws reflect the needs and priorities of all Americans, including seniors. One of the easiest ways to stay informed is by subscribing to newsletters from organizations like the Peterson Foundation. These newsletters provide timely information on economic and fiscal policy, including updates on tax laws and new deductions. Staying connected ensures you won't miss important changes that could affect your finances. Consider signing up to receive the latest news and analysis directly in your inbox. For those who want to learn more, there are many articles and resources available on topics like refundable tax credits, estate and gift taxes, and the largest individual tax breaks. Exploring these topics can deepen your understanding of the tax system and help you make better financial decisions. The more you know, the better prepared you'll be to navigate the complexities of tax law and advocate for positive change. The senior deduction is a temporary tax benefit introduced by the OBBBA, allowing eligible seniors to reduce their taxable income by up to $6,000 individually or $12,000 jointly. It is designed to provide targeted relief to middle-income retirees, but phases out at higher income levels and does not benefit the lowest income seniors. The deduction is set to expire in 2028, adding uncertainty to future tax planning. A phase-out is a mechanism in tax policy that gradually reduces the value of a deduction or credit as a taxpayer's income increases. For the senior deduction, the phase-out begins at $75,000 for individuals and $150,000 for joint filers. This ensures that the benefit is targeted toward middle-income seniors, but it also means that higher-income retirees receive little or no benefit from the deduction. Fiscal responsibility refers to the practice of managing government spending and revenues in a way that ensures long-term economic stability. In the context of the senior deduction, fiscal responsibility means weighing the benefits of tax relief for seniors against the need to control deficits and national debt. Policymakers must balance competing priorities to create a sustainable and fair tax system. In conclusion, the new senior deduction is a significant but temporary change to the U.S. tax code. While it provides targeted relief for some seniors, It also adds complexity and raises important questions about fairness and fiscal sustainability. As the policy landscape continues to evolve, staying informed and engaged is the best way to ensure your interests are represented. Thank you for joining us on this deep dive into the new senior deduction and its impact on retirees and the federal budget.